I'm so excited to have today's guest on the Conscious Edge podcast because if you heard last week's episode, you heard me talking about doing a mid-year review of the budget, how your mindset can be seen in the choices that you make and the way that you spend money. We've talked a little bit about revenue and versus cutting costs. And my next guest, Whitney Elkins-Hutten, looks at, and her specialty really is about wealth preservation and looking even deeper than just what you do in business, but what you do in life. Hey, you leader, entrepreneur, business owner, solopreneur, whatever you call yourself, we know you're a visionary business builder, wealth seeker looking to combine a passion for doing good with leading consciously. It's time to shift from a traditional focus of pure wealth accumulation to one that integrates well-being and fulfillment. You're here for a purpose, and it's time to shine your light. So here we go. I'm excited to have you here, Whitney. Thank you so much for being here.
Absolutely. I'm excited to dive in.
Awesome. So welcome back to the Conscious Edge podcast, everyone. As you understand from the intro there, I have Whitney Elkins-Hutten with us, and I'm going to let her tell you a little bit more about what she does. But if you are new to this podcast, we explore everything that goes into building a business, creating wealth, and all the emotional and life things that happen. So nothing is off the table for us to talk about, Whitney. So it'll be a fun conversation today.
Yes.
And if you haven't hit the like or follow button yet, please do that now. So Whitney, let me give you the floor so you, in your own words, can tell people what you do in this world.
Yeah. So I help high income earners and business owners take their active income and savings and turn it into passive income and long-term wealth.
Which
Pretty simple.
Love. Yes. It's taking all of that hard work that you've done and turning it into something that grows for you. So that's really, really exciting. And how do you do that?
Yeah. So through it, I meet the investor where they're at, help them create, well, first of all, create a vision of what they're striving for. We back into the plan and what they need to be, the actions they need to be taking today. And then I lead them through a process of like alignment, investing alignment. So it's a lot like a process, similar process that you would do in your own business, creating that alignment between what you serve, who you serve, and what you do. We do the same thing in someone's personal life. How do you want that vision to play out in 10 years? And what are those actions that you're taking today to get there? And then we take a look at our resources, both emotional resources, time resources, financial resources, and figure out what is the best path forward for you as an individual in order to hit that goal. And we create an investing plan around it. And then we get down to the tactics. What are the tactics that fit into that investing plan? So it's really a very visualized approach for each investor.
Yeah, we are very aligned, right, in what we do, because I'm all about creating holistic businesses. And so just to give people a little background or history on you, you are a real estate investor. So what is like your history with investing?
Yeah, I feel like I'm kind of a jack of all trades and striving to be a master of one or two, like a lot of investors that get into real estate. I bought my first house with a significant other in 2002. And about a month later, the relationship fell apart and I got the house. We weren't married. So I was the money partner. I had everything, I had the job and everything, had everything secured under my name. And whenever we broke up, I was like, okay, I had the house, but I also inherited all the problems with that house too. So over the next 11 months, I had to complete a rehab down to the studs in a lot of cases. We're talking green shag carpet, psychedelic daisies painted all over the walls. I learned how to do plumbing and electrical, terrifyingly enough, from a book from Home Depot, the Home Depot 1-2-3 book, which is amazing, by the way. Now
I actually have that on my shelf.
Right? I think any of us that have been in the real estate business like greater than 20 years, or at least pre-YouTube, have that book on our shelves.
Mm-hmm.
And then 11 months later, Honestly, I thought this house was going to sink me. So 11 months later, I sold it. And I walked away from that closing table with a check for $52,000. Now, also simultaneously, I had stuffed this property full of roommates who didn't mind living in a construction zone. And we did a lot of bartering and trading. And when I was doing my taxes, I'm like, wait a second. Not only have I been making money every month, living completely for free, I got paid $52K. And it was tax free because of the 121 exclusion, which we can get into that if we were getting into any of the tactics around the real estate. But it was really eye opening for me. I was like, wait a second, I just created all this value. And it didn't require a degree. It didn't require me trading like 80 hours a week like I was with my job. And so I dove all in on real estate, did a lot of what we call live and flipping and house hacking for probably the next 10 years, building up large chunks of equity. And then I realized I can't exactly pay the grocery bill that way. I want money coming in systematically every month. So I started buying rentals. I acquired about 40 rentals before I was like, wait a second, maybe it's easier for me to close on one 52 unit building than it is 42 individual properties. So I started scaling up through multifamily real estate and then eventually got into private equity partnership on larger deals, both as the active general partner and the passive investor. And my portfolio today incorporates I still have a lot of single family rentals, still have some multifamily properties, and then I have my larger buildings. And then I've branched out into express car washes, self-storage.
Well, that's what I was going to ask you is how has your investing strategy, because you and I were at a conference together, in fact, on a panel together, and I was the moderator, had to prepare a bunch of questions. And I had a question for you that I did not have time to ask. So I asked you to come back on the podcast because I really wanted to find out from you, how has your investing strategy shifted recently? Like when did what you were doing stop working? And then what did you do to pivot and why? So I would really like to take that apart for people. I just think it's great for people to hear options of different people's perspectives of what they're doing. So let's start with when you noticed things stopped working the way that they always had.
Well, and it's all subjective. I think as an investor, you have to get really familiar with market cycles and not just and we're not talking about the US stock market cycle. I'm talking about like your local real estate cycle or the areas that you're investing in. And then also what's the market cycle for your particular asset class. Now, for me, I was helping scale a private equity firm. I was one of the 3 partners. I was the minority partner. And this is 2019. And I started seeing huge drops in cash flow and a lot of compression. And we call it, inverted cap rates. So meaning the rate that you're paying in your loan, the cap rate is actually lower than the rate you're paying in the loan. So if you are buying that property 100% cash and you're getting 4%, but the loan costs you 4.25, you're not positively arbitrage. And then on top of that, if the loan has an adjustable rate mortgage on it, it's not to say that you can't make money in these situations. A lot of people made a lot of money in these situations. You just have to understand the risk you're taking. And I kind of felt like that story that you hear about Christopher Columbus, whenever the Spaniards finally hit shore and somebody like touches the Native American on the head and said, "Hey, that's a ship." And they're like, "Oh, that's what that looks like." I had an underwriter kind of explain that all to me. And I'm like, "Ooh, maybe and it was, like I said, if you're okay taking that risk, allocate a certain part of your portfolio to try to hit some home runs. But for me, I was like, wait, in the season I don't want to I already have 50% of my portfolio with that type of lending risk. I don't need any more. So I pushed pause and I sat on the sidelines. I actually kind of felt like the kid, like at the dance with no dance partner going, I don't know what to invest in. Like, what do I do now?
That reminds me so much of in the late mid 2000s when everyone in California, and it was across the country, but heavily in California, people were investing. They're like, it doesn't matter if it cash flows, I'm getting the equity. And then the perfect storm of 2008 happened. And that was like, now I don't have any equity or cash flow. So
Mm-hmm.
it's okay, like maybe short term, but it can be risky if you aren't watching that happen.
Absolutely. Yeah. And it's about understanding markets and the fundamentals of that market. And I don't think you have to become a guru or an economist or anything, but I think just even bringing your knowledge as an investor from a 30,000 view down to a 20,000 foot view to be able to work through your investment strategy, making these decisions ahead of time.
Mm-hmm.
Like, what do you want? Why do you want it? What is your risk profile you're willing to take? What is the timeline that you needed to deploy through? Getting all these decisions made ahead, because otherwise you're looking at deals and trying to make the deal fit your investment profile.
Right.
Or actually, I said that backwards. That's the way you should be doing it. But otherwise, you're taking your investment profile and trying to make it fit the deal. I'm like, oh, this is so totally cool.
So many people try to take their profile and make it fit the deal. So much. And I appreciate what you said about you paused, because so many people taking a pause and just commenting on that markets cycle, individual markets cycle, not on a nationwide level, but even individually. And then nationwide, you have influences. Mm-hmm. And you said, I took a pause. And how do you manage your mind around taking that pause? Because Whitney was a client of the immunity to change process. So she knows what I'm talking about when I say big assumptions. But like, you can have a big assumption that if you're not actively doing something, if you've tied your value to how much you do or don't do, when you have to take a pause because of a market cycle, your brain's not thinking, oh, I'm being smart. This is the market cycle. I'm taking a pause to make sure what I invest in aligns with my investment strategy and my values. I feel lazy. Like, I feel like I'm not doing enough. Mm-hmm. Did you go through any of that, or what did that look like for you?
I think I had a little bit of fear of missing out. But I think the biggest thing that I learned is that I had an investment strategy so much as, hey, let's diversify across multiple asset classes, multiple deals, and multiple markets. Mm-hmm. What I meant, and it took me through the rise of interest rates to really learn, it's almost like a 3D investing approach, right? You have to have your 2D, like your operators, your markets and deals, especially as a passive investor, but you need to also be diversified up and down the capital stack. Meaning I needed to have cash flow coming in from like either individual debt instruments or notes, or maybe it's bonds in the stock market. I'm not a stock market girl. Like, I'd stay away from it. I think that's just a total casino over there. So I actually stumbled into actually deploying capital into first position lien real estate debt. And I just paused there. Why?
So explain that in case someone listening is like, what did she just say? So just say it one more time and explain it.
Yeah. So I deployed into a fund that deploys capital. So like a hard money lending fund. Mm-hmm. They deploy capital into debt instruments that are made on single family real estate. I was like, wait, single family real estate is not suffering the same challenges of like my multifamily portfolio or even self-storage portfolio through this market. It's really stable. It's short term. So there's you can be very nimble in this environment. If rates start going up or something starts happening, and you can exit pretty readily as opposed to waiting 2 or 3 years. But that first position lien, meaning I'm the first in line to get paid, mm-hmm. or the fund is, should something go wrong on that property. And again, it's just plain vanilla. Those were the debt funds that I was looking for. I wasn't looking for anything where they were playing the numbers game with 1% to 3% default rates, trying to find the best opportunities out there. I wasn't interested in the funds where they were like, hey, we have a mix of single family, multifamily, self-storage, commercial, ground up development. I'm like, I don't want to be exposed to any of that. I want the simplest fund that I can be in that offers me not only monthly cash flow, but liquidity. Meaning if I did find a better investment, I could liquidate my position and get out in under 90 days to go make that investment. And again, it was more of like holding. I just wanted to hold cash there. And then as the rise in interest rates extended longer, I mean, I was one of those people that were like, I don't think this is going to be over in 6 months. I think that we're out of this in 3 years. Man, that's like a good time frame. I was like, wait a second. I think this is really, I started adjusting my investment theory and philosophy to be not just 2D, operator, market, and deal, but how do we get that diversification up and down the capital stack? Because I had that stability in cash flow when other investors and the liquidity, I had the liquidity too. Like I can go invest in the equity deal right now. Whereas a lot of other investors were feeling the pain because they didn't have the cash flow and they didn't have the liquidity. I'm going to pause there because there's lots to unpack if we wanted to.
My brain is going, okay, yes. And okay, so let's just remind a review, like a capital stack. In my head, I go tech stack. Like that's like everything we use to deliver your coaching. Okay, capital stack is how you have revenue, your revenue streams.
It's the different layers of money that go into a deal. So think of the base of the triangle as being like your senior debt position, right? Like if you own a single family property or a multifamily building, that's generally the bank, the note in the bank. And then the second layer would be like a home equity line of credit or a home equity loan or a second loan, construction loan, right? That's the second layer. And then we have this big black line drawn across the screen because now we move out of our debt layers probably into the equity layers. And so we get higher returns in the equity layer, but we also take on higher risk. And we can, equity layers can look like private credit, preferred equity, and then we move up into the common equity classes. Now, you can have cash flow in every single layer of that stack. Okay. But if you're banking on the cash flow in the common equity classes in that upper tier, that's the first to go away usually in a market downturn or some sort of challenge. Like your expenses go up, you experience a storm, you have an insurance claim. Usually you have to absorb the cash flow in order to keep that property afloat. And then if the market cycle really takes a challenge, then the equity gets compressed too. Now, on the bottom part of the capital stack, the bank's still sitting there going, well, okay, all the equity can disappear. Even the equity can wipe out the second note position until we get affected. It's not to say that the lower capital stack investing in those first position notes are 100% risk-free, but you've got multiple layers of equity cushion above you.
So what you're saying is you look at entering into deals at different points in that process when you say a capital stack.
Yeah.
That's not a term that I have heard used.
Usually I have like a little visual too, and draw my like little arrows too.
Yeah. Is that a term that's commonly used, or is that a term that you use in your teaching?
For people that are versed in limited partners, general partners, people that in the private equity space, they understand that term. Even if you buy your own single family rental, you should understand that there is a capital stack.
Yeah.
The bank is the first position. No, you're the common equity holder. Okay, there just happens to be 2 layers of money as opposed to like 3 or 4 layers of money.
Right.
So it's a term that everybody should know as an investor, but not everybody does.
Yeah.
And I think that's, again, kind of like going back to the explorer landing, showing up on the beaches of the West Indies or something like that. That was like the light bulb moment for me. I was like, oh, wait a second. I am all diversified up here in the common equity classes, but if that common equity class experiences some sort of like market pressure, in this case, rise of interest rates from lending, that affects everything.
Yes.
All my investments were exposed. And I was like, wait a second. So just by happenstance, I had added in these debt layers. And in my mind, you could go back to immunity to change. I'm sitting here going, fear of missing out. I'm like, my money's not making enough money. I'm not like growing enough. I don't have enough tax benefits coming in. I got to get this money out of the debt fund and get it deployed into equity deals. And then I was like, hold on, this is what is allowing me to continue to live my current lifestyle the way I have. And not only that, I'm able to compound it and I can continue to grow my portfolio. Is it slower? Yeah, a little bit slower, but it's safe.
Mm-hmm.
Okay. It's liquid. As soon as I find an equity deal that I really want to dive into, I can liquidate that position, go in the equity deal. It's nimble. It's almost like a war chest of money to take
Mm-hmm.
advantage of the market cycle.
Yeah, that makes so much sense. I had not thought of it. And the reason I had asked about, does everybody know what a capital stack is or what that means is, as I have been in real estate, I've talked about this on previous podcasts, there's new terminology that has come out in the last, since 25 years ago. And a lot of it coming, I believe, from a lot of the financial sector. And so when I hear things, sometimes I question, maybe I don't know what I'm talking about. And I have to go, what does that mean? And I feel so silly, but you would talk about big assumptions at play. Like if I don't ask, if I'm questioning it, someone else listening is questioning
There's 100 other people that are asking the same question.
Exactly. And so often I think people hear things, they don't ask, then they don't know. They actually do know, but they don't know what someone's talking about because of the terminology that gets slung around. So that's why I'm like, okay, explain that, so that somebody now knows what that means. And it makes perfect sense now. Okay. So you diversify into what different parts of the capital stack to, it decreases your returns, but it's acceptable for your situation and what's happening in the market. And you manage your mind around that. I also heard you say that you invested in some other things as well. Is that what I heard you say at the beginning?
Yeah. So I invested into some businesses like express car washes and then other kind of more momentum investments that haven't quite honestly done the best. so, anyways, I think for me, how I've adjusted my philosophy is making sure that I am in a hard asset. I've done some of the kind of higher tier kind of, wouldn't put them in completely in venture capital, but more of a venture capitalist scenario. And I'm like, I'm not there yet. For me, my particular investor thesis is capital preservation for me is key. I don't want to get knocked out of the game. Mm-hmm. And as much as I can understand how that investment helps me protect my capital and then creates cash flow, and then for me, it's a bonus if I can get equity growth out of it and tax benefits. Okay. And for me, really pulling back and understanding who I am as a core investor was very key. Otherwise, up until probably 4 years ago, I was just like everybody else. I'm like, ooh, that looks good. I'm going to do what they're doing. Like that person looks like a really seasoned investor. They're doing amazing things. Like if they wanted to invest in a Bitcoin mining fund, I'm going to do that too. It looks like amazing. If they vetted it, I'm still asking all my questions. I'm vetting the operator. I'm vetting the deal. But I had to go back. I really had to go back in the past 3 or 4 years and study what investments did really well for me, that even if they weren't a home run for me, why I would still go into them again from a core philosophy of like, it's because they hit that capital preservation, cash flow, a little bit of equity growth, and then the tax benefits. And they weren't the whole swinging for the fences type of equity investment.
Yeah. So it's what helps you sleep at night.
I like sleeping well at night, but a lot of what affords me that is, I think of it as 3 tiers to investing. And I know a lot of people when they start I watch it all the time on Bigger Pockets, those type of forums, or even Passive Pockets. They're launching into their first deal, not fully understanding that you have to have your oxygen mask on first as an investor. So if we talk about, how can we best preserve our capital? The number one thing is making sure that you actually have reserve funds set aside. So should all of your investments pause cash flow, that you actually have another stream of cash flow coming in from someplace else, or reserves set aside to last you 6 or 12 months or longer, whatever your sleep well at night factor is. I know we talk about this all the time from multiple different angles in the finance space, but I can't get past that is so important.
I so agree. When you feel personally stable, you're able to take more risk, which means more payoff, but you're also not affected if it doesn't pan out. It feels a lot safer. So I think having your own oxygen mask, as you say, or making sure your personal finances are stabilized is so important. Because if you're riding and I see this a lot on business owners of all kinds, not just real estate investors. If everything is banking on your business, the chances of you making a tactical error out of fear or big assumption is super high.
Very, very high.
So I want to transition just a little bit because the way that you and I connected was you are coaching and you have a book that was coming out. Right before we connected, you had a book that was getting ready to come out. And so you wanted to engage in some mindset coaching. And what was happening in your world that made you say, now I need to do this? I need to invest some time and energy into getting coached.
It's funny because I had actually had that feeling for at least a year, if not longer, before we met, but I hadn't found the right plan of attack in a way for that. I think I was still working on all the different tactics as opposed to going back and understanding what the root cause was. And the root cause was me. I'm just going to say, I was in my own way. And every time we met and we'd have a conversation, we identified a lot of the things was I wasn't being clear in my boundaries with my coaching clients on exactly what I did, how I could help them, and how I would work with them. And you would just naturally just say, oh, Whitney, like, what if you said this? And I'm like, I can actually say that. And so I was like, tell me more. I'm like, writing down all these
and
notes.
It was simple things like, this is when I'm available to coach. What works for you? And you're like, I could just set the time. Yeah. Yes, you can.
Yeah. And I think it was understanding for me, I knew that I brought worth. I think what I felt is because I was allowing them to run over my boundaries, that they didn't see the worth and the value that I would bring to them. And so I had to let that go. I had to be able to state my boundary. This is what I can do in the parameters I can do it. I know I can help you. Let's jam. Let's get it done. And I had to be okay and allow them to say no. And I think so many business owners, I see it with people that I work with too. Well, I even see with a friend of mine who is an amazing, what she does in regenerative health. I mean, she will work nights and weekends and take time away from her kids, and she's bitter about it. Right. And I think we all feel like, I think that we have to pay that due when we're scaling our business. And I think we're actually doing a disservice now, or at least now that's what I learned. I'm doing a disservice to my clients when I allow them to do that to me.
Yeah. They don't get the best of you
Exactly.
when you do that. So we went through and you did a series of discovery and testing. And now you've got nice, healthy, I call them healthy boundaries with flexibility. So if you want to adjust things so that you don't miss an opportunity, you can. But as a general rule, you've got a good relationship now. And you have a program that you run and a book. The program is based on the book, correct?
Yes.
Okay. So now let's talk about what you do in that program with people to help them create money for the long term.
Yeah. So the book, Money for Tomorrow, How to Build and Protect Generational Wealth, is a 40,000 foot view of a lot of the things that we do in the Financial Edge program. And all of it is in the service of how can I teach you or help you as a high income earner, as a business owner, take your active income and savings and turn it into that passive income and long-term wealth. Now, we break it down into 4 different modules. The first module is we're figuring out all the different ways we can create money in our environment. And I think a lot of people think of creating as going out and get a better paying job, which might be one way. But this is how do we look at our current ecosystem, our current financial ecosystem, our current resources, and move some chess pieces around to maybe generate an extra 30K a year in savings. Because if we can get a positive margin for all my business owners out there, we've got more income versus what's going in or going out. Like now we've got money to invest. Okay. And then in the Keep, we're looking at the 6 different ways that investors and business owners lose hundreds of thousands of dollars a year. I'm not talking about cutting the cable or like lowering your grocery bill or anything like that. I'm talking about how do we save, make strategic one-time moves that are going to keep $100,000 this year in your portfolio, which you compound that out at 8% over 10 years. We're talking about those are $1 million moves. And you stack 3 or 4 different changes like that, all of a sudden your net worth immediately changes by $3 or $4 million.
Powerful.
Powerful stuff. And then the third module is now that we've got those first 2, the create and the keep kind of buttoned up, now we're in a safer, more stable place to actually deploy capital and grow it. Okay. And then we're going to take a look at, do you have the different tiers of your investing layers satisfied? Okay. Because everybody, I can't tell you how many people I get on the phone with these days who are like, what do you think about Bitcoin? I'm like, I think it could go to $1 million or it can go to 0. I don't know. What do you want me to tell you? But we need to fundamentally understand what investments will work for you as an investor.
I was going to say, wrong question, not what I think. What do you think? Like, what do you, the person risking it, think? More importantly, right?
And I think those fundamental questions, what we do there is we create the investor thesis. An investor might decide to stay in active real estate, do fix and flipping and buying single family rentals or a small multifamily. Or an investor might go, hey, I have a higher and better use of my time in my own business or own job. Teach me how to deploy it into other people's operations, like in, say, syndicated or fund investing. So we create a plan around that. And then the 4th tier is how do we make sure that we are putting together a plan to pass on that wealth to the next generation? And it's not just about the estate planning piece. That's one of the 3 fundamental actions that we need to take in that tier.
It's really, really powerful when you stack it all together. So the introduction to that is money for tomorrow.
Yes.
Essentially, that first stepping stone, right? And
yeah, I actually wrote that book, or the premise of that book was a bunch of notes that I was jotting down from my daughter because should something happen for me, I wanted her to be able to, when the time is right, pick it up and go, what was mom doing? Oh, this is how she adjusted her mindset. This is what was happening, the moves that she had to make. This is how she thought about money and treated money and grew the money and then made sure that it was there for me, like whenever it was time to pass it on. I never thought in a million years it would become a book, but I wrote those notes. I started actually deploying the framework with my coaching clients. And then spoke at a Bigger Pockets conference one year and they were like, hey, we don't have a book like this. And my friend was like, elbow, she was like, she'll write it for you. I was like, yes. What did I just say yes to? Okay, we're writing a book.
That's funny. Before my boundaries were strong. No, I'm teasing.
I know I'm kind of a ready, fire, aim person at the end of the day.
Yeah. No, and that works. It works to an extent. And then you need a framework, though, around that risk taker. There's a lot of people, I think, inherently that are attracted to entrepreneurship because they are bigger risk takers. People who are not risk takers they are entrepreneurs. Like they would be so terrified to do some of the things that we go through and do. So, but when we are unhinged risk takers, it can become very messy and very volatile. And when the market's up, things are great. And when it's not, then it feels really unsafe. So I think that book does a really great job to put some framework around creating your version, each individual person's version of safety. So you and I came up with an idea because you have a goal. Whitney came to me in one of our coaching calls and she was like, hey, I want to get 100 reviews on this book for Amazon because when we're talking about book promotion, getting 100 reviews on Amazon really helps it be seen more. And I am all about supporting. Well, I have a passion for mothers who are creating wealth. Like I just do. And I think that women creating wealth and then passing it down to their children is so meaningful. And so I want to help you do that, number one. And so she has this goal to get to 100 reviews. And what we're finding is that people want to read the book fully before they will give a review, but they're busy. Life is busy. And so how do we get people to read the book who have it? And how do we get them to follow through with leaving the review? And so we came up with this idea. You thought it was really cool, something we're testing out. And so tell them a little bit more about what you're going to do to support people and hold them accountable for the information. I did a podcast several months ago now, about coaches who write books and how the gold is really in your book. Like if someone just read it and did what it said, it would be life-changing. But so many people don't follow through with reading the book, or they get into the book and then they realize they have some mindset challenges. And so that's where your coaching comes in play and getting in that additional accountability. So we came up with an idea. So you tell them what's available that I think is so cool. That's going to make a win-win where you're going to get your 100 reviews and they're going to get something special.
Yes. So for the month of August, every Thursday at 2 p.m. Mountain Time, I am doing a book club over the book. So essentially, we're going to read a section of the book, and then for an hour, we are going to talk about what are the big movers in that section that you need to take. And it gives you space not only to read the book in manageable chunks, but also to come into a space with me where you hear me talk about it. Because sometimes we can read a book and you're like, I think that's what they meant in the book. So we get chances to clarify and then also put together commitments that you're going to take action on before the next time we meet. And so if you wanted to, again, just want to dive deeper in the book and take action on it, or even if you just wanted to get an idea, like at a very high level, what it would look like to work with somebody to help you get your financial foundation set, this is a perfect opportunity. It's for new and seasoned investors. I guarantee you, even if you are 50 deals in as a passive investor, you'll get immense value out of this as well, because I do find that most passive investors are missing very light on how much money they keep, and then also very light on their investment strategy as well.
Yeah. And I am hearing from people who have learned things from you, and they're like, oh my gosh, like just these tiny little things. It's even sometimes things we know about, but we don't take any action on. And that is the key, is the action taking. So I love this idea for you to have this book club. It starts when?
We're going to start August 7th.
Okay. So that's good.
My birthday present to you guys.
That's so awesome.
So August was my birthday month. So we are going to launch it in August. And so it's just really a celebration. Call it a new school year, whatever. But in celebration, there's never the right time to do this work.
No.
So just do it now. Let's get it.
Well, and I'm thinking this podcast is airing on August 5th. So that's like 2 days from now. And I can already hear someone going, oh, I can't do it because go ahead.
I got you. The sessions are going to be recorded. So sign up and you will get as the sessions post, you'll get a file folder to listen to the previous recordings. And those will be available for a certain time. Why? So you are encouraged to take action and not just file this away for someday in your inbox.
Yes. So the other thing I was going to say, though, is I would not say listen to the recording. I would say get it on Audible, because there is Audible of it, correct?
For the book, yes.
For the book. Listen to the first section that you need to for that Thursday call. or catch up, just show up and be in the room and then get yourself caught up for the next session. Because if you wait for the perfect timing to do things, you never do them. And Whitney's doing this to reach a goal. This isn't something that may always be available to you. So I think someone would be crazy to use that as an excuse. Like, oh, the timing's not right because it starts in 2 days and I don't have time to read. Like, no. Where else are you making that same excuse in your life and your business that because it's not the ideal timing, that you're missing a really incredible opportunity that will change your financial future forever and for future generations? So, any last words, Whitney?
I mean, I always encourage people, show up as you are. Even if it's messy, show up, be in the room, like you just said. So,
where do people go to register? I'm going to link it here, but for anybody who's listening and they've got their paper and they're like, where do I go to register? Do you have that link?
Yes, you can go to ashwealth.com/book club.
Okay.
And that's ashwealth.com/book club.
ASH. It sounded like you said ESH. ashwealth.com/book club. All right. And I'll make sure I link it here for you in the show notes as well for people to be able to register. Such an amazing opportunity. Thank you so much for being here and sharing all the things. I so appreciate you. I love working with you. Whitney is just always an eager, open, coachable client. Best comes with the best attitude and open to coaching. And it's been really wonderful to watch you just transform. And I pinch myself when I go, oh my gosh, like I get to coach this powerhouse woman. Like it makes my heart so happy. So thank you for trusting in me too.
Absolutely. Well, thank you for being there.
Yeah. All right. With all of that being said, everyone, make sure you go register. Sending you so much love. And of course, if Jonathan were here, he would say, be well. Thanks for listening to the Conscious Edge podcast. Make sure you subscribe and take a moment to be kind and share this episode with someone you care about. Leave a review to help us bring more compassionate leaders building businesses and creating wealth to the table. And for show notes, head over to consciousedge.com/podcast. This podcast and the linked materials are presented solely for general information, educational, and entertainment purposes and should not be taken as personal or medical advice or any kind of mental health treatment. Please consult a medical or mental health professional if you feel you need such services. Please be advised that all investing and entrepreneurial endeavors involve risk, and the use of the education and information on this podcast and linked materials is at the user's own risk.
This podcast is part of the Sound Advice FM network. Sound Advice FM, women's voices amplified.